These are a couple of concepts I put together just so that when you're seeing somebody in person or having a conversation with them in the office, I wanted to give you what I call napkin talks, just a couple of little napkin talks. So if you're meeting somebody, at a coffee shop, or if you're meeting somebody, like I said, in their office, at your desk, wherever it happens to be, these are going to be a couple of concepts that will position fact finding and give you an idea about what the kinds of things they're thinking about. So I'll go to the first concept. There's three kinds of money. And I always draw this on a napkin or a piece of paper in front of my prospect to give them an idea about this particular concept. The three kinds of money are the money you've accumulated so far. So there's money that you've accumulated in an RRSP. And when you are sitting there with your fact finder, your needs analysis, you're getting some data from them about, their current balance on their mortgage or their debt, loans, emergency funds, final expenses, education, liquid assets, including cash, stocks, bonds, mutual funds, real estate. And I'm going by your Western Financial Group's fact finder. So when they answer, I've got some savings saved up. And so that's starting to formulate their accumulated money. And we don't want to reduce their accumulated money or take money away from their potential to accumulate money to do life insurance, because they won't like that, first of all. And secondly, they'll buy less. They'll go on needs-based planning versus wants-based planning. And we want to get them in the mindset that people move in the direction of their wants. You always want to make sure that your needs are covered off, but you want to get the client moving in the direction of their wants. And you want to be the person that can help them position them for achieving their goals and objectives in their wants category. But let's for a second assume that they've got some money saved up. And I'll show you an example of that in a couple of minutes. Then there's lifestyle money. The old line that we used to be taught in the insurance business was, how much on a monthly basis can you set aside to achieve your financial goals? And sometimes we'd give them a number. We'd say, how much between $75 and $150 a month can you afford to set aside on a regular basis? And they would give you an answer. They'd say, 75, nothing, or 150. Usually, if you said 75 and 150, they'll give you somewhere in the middle. So they don't feel too stressed, but they know in the back of their mind that whatever they deposit in whatever you're recommending, whether it's more accumulation money or protection, they're reducing their money towards their lifestyle. So they're going to diminish their lifestyle to do whatever it is you're going to recommend. Now, the question I'd ask you is, how much do you want me to reduce your lifestyle to buy life insurance? And I'm not even going to answer or wait for an answer in the chat, because you're all going to say zero. You don't want to reduce your lifestyle to achieve your financial goals. You want to increase your lifestyle. We all do. Sometimes that's not a reality. Sometimes we have to do some lifestyle changes to achieve our goals, but sometimes we don't. That's why I want you to start thinking about where they can and you can help them change the way they manage their money. And that starts in the transfer dollars. The third kind of money is transfer dollars. And these are dollars that are transferring away from them unknowingly and unnecessarily. Now, unknowingly means they just didn't know. They weren't aware of it. They don't understand it. And they don't know how they're financially set up to be able to describe where they can make those savings. That's why they're counting on you. So when you go back to your Western Financial Group fact finder, which we'll do in a couple of minutes, like I said, you've got a mortgage balance at the bottom of your page. You've got debt, loans, balances, emergency funds, final expenses, a place to enter those numbers. We need to know what those numbers are to find out, in fact, if they are transferring money away from themselves unknowingly and unnecessarily. Anything unnecessarily being transferred away, we can recapture or reduce that unnecessary transfer. We're looking for those opportunities. When you see seminars that are run from the US or other parts of Canada, where they're trying to do these seminars on finding the money, you might have heard that term before. There's a group out of the States that does a lot of this. And finding the money is where they might be able to restructure their financing, reduce credit card debt, and those freed up dollars go towards then their lifestyle, their accumulation, and protection. So we'll talk a little bit about that as well today. Where they might be having those transfers is the number one place people have transfer dollars is credit card debt. Particularly right now, people through COVID have gotten themselves, some people have gotten themselves into a bit of a pickle where they've, gone back to their line of credit, gone back to their mortgage, refinanced their mortgage, or exercised the ability to increase their line of credit and or put money on credit cards. If you're holding a balance in credit cards, you guys know, you work, at an institution that does this kind of work where they might be servicing debt at 28%, 19%, anything over 19 is ridiculously high. And there are things and solutions that we can bring to the table to solve that problem. It's the way we describe that problem to our client that gets them moving in the direction of their wants. So taxes, there's some ways to minimize taxes. Wealthy people, that's where I focus most of my work, is reducing their taxes today and in the future by putting those investments in places after the RSP has been maximized, after the TFA has been maximized. There's only life insurance really that you can put money into to eliminate taxes on growth, but there's some other structural things you can do as well. Term insurance costs, again, nothing wrong with term insurance, don't get me wrong, but term insurance in terms of a long-term solution is not the best answer to a total financial plan. We'll talk about that as we move forward. And we'll talk about that more when we meet in person in Calgary. Deductibles. I don't want to nickel and dime things, but sometimes people don't even know what their deductible amount is in their mortgage or their home or their car insurance. And we were taught as kids when I was growing up, I think the deductible was $250 at the time. It's gone up since then, but I think it's around $500 is the lowest deductible you can get, maybe even $250. And it depends on which province you're in. I know there's some different provincial rules, but sometimes you're paying for a deductible that if you got into a $700 or $800 accident, you would never put that claim in. So you're paying for a deductible that you probably won't exercise if the eventuality of an accident came into being. That difference in premium is sometimes enough to buy this term insurance without reducing their lifestyle money or their accumulation pile. And now you have found some money that will solve some of their insurance want or need, in this case, need, right? Mortgage payments. Some people are extra depositing to pay off their mortgage. And it's not necessarily the best thing. We all think that, the bigger the mortgage, the more interest I'm going to pay. And over time, that's correct. But if your mortgage right now is at 3% and going up based on what's happening these days, but if it was at 3% or 4% and your investment portfolio is doing 8%, you're better off to put money in your investment portfolio than pay off your mortgage, which is at 4%, and your investment portfolio might be doing 10. I'm not here to debate that, and we'd have to look at what portfolio you have and where your investments are and everything else, and no past indicators of performance on any guarantee of future indications, all that stuff. Loan investments. So are they investing with collateralizing or loans to invest? Final expenses, again, is an item that's on your list. Are you prepaying that funeral, or are you just putting some money aside in life insurance that'll take care of that financial expense at the end of the day? Are RSPs, again, not here debating whether RSPs are good or bad, but for some people they are bad. For many people they are good. You're postponing a tax to a time in the future where the tax might be higher or lower. You can't guarantee that if I'm successful, my tax rate will be lower in the future. And even if I'm not successful, if I'm 25 and I got my first job and I'm making money and someone said at the bank, you should put money in an RSP, I'm putting money away in an RSP now at 25 that is going to be at a low rate. And when I go later at 55 or 45 and I go to take that 65, take that money out, I'm taking that money out actually at a higher rate than what it was when I put it in. So there's no tax savings necessarily in that scenario. There's a tax postponement. So you're tax postponing the calculation and the tax, right? And then clawbacks on government benefits. If you are successful and you are having success financially in your life, you're going to get clawed back on government benefits based on how much you're getting in terms of your RIF payments at retirement. So there's some things that we can do to prevent that from happening. You still have a much higher income, but at a lower tax rate, and you will not negate yourself from government benefits if it's structured properly. So it's more about strategies than it is. So that's the three kinds of money. I want to position that conversation as we go to your fact finder form. The other thing I want to address is your running factors of life insurance. Life insurance today, if I bought $500,000 of life insurance death benefit today, and I was, again, 30 years of age, then there are going to be some eroding factors that are going to diminish the purchasing power of that $500,000 in the future when I'm more likely to die. So if I died today, the $500,000 is worth $500,000. But if I died 10 years from now, some things are going to have happened in the past 10 years that are going to impact the value of that $500,000. So if I bought $500,000 of term today, and you'll all have clients that have come to you about insurance that have, and they think they have a lot. They say, I've got $250,000. I got quite a bit of insurance. I've got $250,000, which sounds like a lot, 20 years ago. But today, $250,000, as you know, doesn't even pay off a mortgage on a house. So when you go to sell insurance, you got to be talking a little bit about what's going to happen. There is going to be inflation. Right now, we're in a rampant phase of inflation, temporary or not. There'll always be inflation. So $500,000 today isn't going to have the same future value as it does today in terms of its purchasing power. So when someone says, I want just $499,000 because that's what my mortgage is, and 5 years from now they move to another house, now they're getting mortgage insurance again. So another reason why they want individual insurance versus mortgage insurance at an institution, they might want to have controlled individual insurance in that scenario. But the other reason is it won't keep pace with whatever happens in the future. So there's inflation is the first eroding factor. Taxes, there's always going to be taxes. Now, life insurance, as you know, pays off tax-free. But there are other parts of their life are going to be impacted by taxes. COVID is going to have a long-term effect on our taxes as a collective, as a group. And the $500,000 isn't going to buy as much as it did now in the future because of that. Technological change. The example I always bring there is, you've got the iPhone 6, iPhone 10, now iPhone 13. You have things that you've got new things of, flat screen TVs as another example. I want to buy an 85-inch TV now because I can. It's a want, right? But I have a 65 and I have a 75. But technology has changed. That screen went from 3 inches deep to a half an inch deep, and I want that hanging on my wall. I don't want a 3-inch screen hanging on my wall. I want a half-inch screen. And as I walk into Costco, the first thing you see on Costco on the left-hand side, depending on which store you're in, is these brand new TVs they're selling for $1,300 that we say, my TV's okay, but look at the screen. The color's so beautiful. I need to have that. Now, the question is your family's attitude towards that going to change if you aren't here? They're going to want the new and most advanced everything. If something happened to you and they didn't have the money to buy it, do you feel any desire to provide them enough money to buy those things as a result of technological change? The other thing that happens is planned obsolescence. I always use this example. Back in the day when I first got married, I got my grandmother's fridge. My grandmother had given it to my mother. It was an old Viking. And this thing had to be defrosted on a regular basis, except that it worked still. It was like 25 years old when I got it. I got it from my mother, who got it from her mother. I used it until I could afford a decent fridge. And I gave that fridge to my son's friend to keep beer cold in his garage. I think that thing lasted 40 years. Today, you can't buy a fridge that's going to last you more than 5 to 10 years. They're going to blow up. Those things are your car is built with plans to rust. The way they do that is they build things today with planned obsolescence. So you have to buy that new one because of technological change, whether you want to or not. Things are just better today in terms of their ability to do things, but not structurally as good as they were back in the day. That's why the prices have gone down on these flat screen TVs and everything else. Propensity to consume. Once you've saved money, you tend to spend that money. You're saving for a holiday for 2 years from now, and all of a sudden you go to Costco, you get the urge, and that holiday will wait. I need that flat screen TV. So there's other factors. Lost opportunity costs is another one. If I took that $1,200 and bought that TV, I now have a lost opportunity cost on that TV. That $1,200, that's 6% in my investment portfolio for the next 30 years till I'm 65, has cost me about $3,000 to $4,000, not just $1,200. And we all forget about the conversation about lost opportunity costs. Market risk. There's always going to be market risk. Right now, very volatile. Interest rate declines. We've had all kinds of that. We're going to see a rebound of that. But $500,000 invested today is going to get a very low rate of interest unless I'm going to go into market. If I'm going into the market with that benefit amount, I'm at risk now. Is that what I want to be doing? And then interest charges and loans. We talked about that earlier in my earlier slide. So there's just a little arrow that you could show somebody at your desk. They'll come in and say, I want to buy a whole bunch of insurance. I want $500,000. And you might say, Mr. and Mrs. Smith, have you thought about what $500,000 is going to buy 10 years from now? We have needs and wants in our lives. I could take a bus to everywhere I wanted to go in my little town here. I live in Grimsby, Ontario, a small little hamlet outside of St. Catharines, between St. Catharines and Hamilton. Used to live in Burlington. I got out of Burlington, took my profit I got on my acre property, bought a house on the lake. And then I sold the house on the lake, downsized, and now I live in a house about the size of that one in the middle there. It's actually a bit bigger than that, but for sake of argument, let's say it's that one. But there's needs versus wants, and those needs versus wants are all lifestyle decisions. So here's what I'm going to ask you. Are you traveling around on a bus, or do you have a nice car? Are you in a smaller house? Not that this is a small house, but I'm just saying, is it that kind of house or that kind of house? And are your kids going to public school, or do you want them to go to a private school or college and education, a higher learning institution? We have these choices. And I think if we all sat back and said for a second what we'd like to have happen, I think we'd like to have this picture rather than these pictures. Is there any reason why your family shouldn't have these pictures if you're not in the picture? Or does that matter to you? So you start to see that people move in the direction of their wants. As long as it doesn't reduce my lifestyle, reduce my potential to accumulate money, I'm going to head towards the wants list. And I need to work with someone like you folks to get me to live in that world as opposed to the world of scarcity. So there's a world of abundance and a world of scarcity. And we want, through our training, to get your clients and you to live in that world of abundance. Let me give you another real quick one. This is a positioning piece for another concept that we'll talk about when we do see each other live, person A or person B. And this is really one, again, you can do on a napkin talk. I used to, when I first got in the insurance business, I had this conversation with every client. There's spenders and savers. So person A, person B, spender versus saver. The spender gets paid every week, every 2 weeks, gets his money. And I just drew lines here. I just did this before we did our seminar today. You draw a circle on a piece of paper. You got the money coming into the top of the circle, and you draw lines across that circle to the bottom. And you got your phone bill at the top. Your car payment is the next one. Your home is the next one. Food, clothing, everything else. And you try to save what's left at the end of the day. And what you'll find, if you're in that mode, there'll never be anything left at the end of the day for you to save. That's why the wealthy barber made millions of dollars selling his book, The Wealthy Barber. David Chilton told everybody they should be this person. Save 10% of your gross income. If you listen to Susie Orman or Dave Ramsey, anybody like that, they'll tell you, pay yourself first. So if I got paid and that money's coming into the top of that circle, and that first bill is 10% towards my accumulation pile, then I can spend the rest of that money and not worry about the fact that there's nothing left at the end of the month, because I've already done all of the saving in that first bill. What happens is people get climatized towards paying their bills. You do not pay your hydro bill. They turn it off. You don't pay, no matter what the price of gas goes to, you won't not drive. You will drive. If you have to go somewhere, you're going, and you're going to pay a high bill for gas. And you're not going to reduce your lifestyle to put gas in that car. We all want to live in that world of want. So you have a choice of being the person on the left or being the person on the right. My question to you is, which one would you rather be? And they're going to always say to you, I want to be the guy on the right. Great. Let's take a look at this fact finder and work through it together. The other concept we'll move to really quickly is this one. There's, again, three kinds of scenarios that people go through. There's spender, saver, and wealth creator. So we talked about the spender and the saver just a minute ago. We're going to talk about the spender a little bit more right now. So you graduated from university, you got out of high school, whatever. First thing you do is you buy a car. You go into debt. You get a job and you get a car. Then you get married and you buy a house. And you're always living below that zero line. You're in debt trying to get back to zero. So you earn, you borrow money, you finance your house, you finance the car, you're financing that TV at Costco because you can do that too. Or you buy it on their credit card with CIBC now instead of, they know how to make money. They went from Capital One, I guess, to CIBC because they get better rates, right? And there's a lot of transactions. So the institutions know how to make money. And they don't make money by carrying a lot of debt, but you earn, borrow, live below the zero line. You're always fighting to get back to zero. If you're lucky, you get out of zero eventually by the time you retire, and you're just in time to get CPP and OAS. The next person is a saver. So you save up a bit of money, and then you want that flat screen TV, you pay for it cash. You save up for that trip to Mexico, you pay it cash. But it always brings you back down to zero. So you live and buy and live at that zero line. Excuse me again. That's not a wealth creator. That's a saver. And nothing wrong with saving, except that when you go purchase something, you've lost the power of compounding on that line. And whenever you lose the power of compounding, you can't get it back. Once you spend that $25,000 on that kitchen counter, it's not coming back into your life. It's gone and lost forever with the lost opportunity cost. So you want to collateralize to pay for that counter and have your money earning more than the debt is costing you currently. And there's ways to do that, which again, we'll talk about when we meet in person. The wealth creator knows that philosophy. He does things structurally at the beginning and says, I'm going to position myself today for my better future. And whenever I buy something, I'm going to borrow it from myself, pay myself back, earn money on that, but never remove my money from that compound line. Every time we put $1 in on the compound line, it goes in at zero. So even 20 years later, when we put $1 in on that 20th year, it's like it's at the bottom of that line. Your money doesn't compound at year 20 to the future. It's compounding from that $1 into the future. So every time we take money out of our account, we're bringing that money back to zero. And we want to talk more about that and explore that idea when we get together again in person. But another idea that you can quickly draw on a napkin or a piece of paper in your office to explain to people, if you could put yourself in this position of being always on that compound line, but when you wanted to make a capital purchase or a larger purchase, and you could borrow money from someplace at a really low interest rate, is that a position you'd like to be in? And as soon as they say yes, we've opened that opportunity to have a conversation. So those are the three concepts that I wanted to share with you. I'm going to go off share for a second to see if anybody has any comments and or questions. So hopefully you've got your fact finder out there handy. I'm looking at the fact finder now, and what I'd like to ask you to respond to in the questions here or the chat is, where on that sheet is there an opportunity to talk about wants? Is it needs-based planning or is it wants-based planning when you look at your fact finder? Yeah, it's all needs-based planning, right? Which there's, again, absolutely nothing wrong with. But needs-based planning is minimalist planning, right? It's just enough. It's just enough to get by. Like if I bought that, that would be enough. And it would just get to pay off the mortgage. It looks like mortgage balance owing. debts and loan balances. The line that I used to use to position this kind of a piece is, listen, you don't have to replace your income for your spouse for the rest of your life. What you could do is just leave her with zero debt, or him with zero debt. Have you interest in leaving your family with zero debt? And that's all. And they'd say, yeah, I want to leave them at zero debt. Great. That's pretty easy calculation. It's just tally up the debts they have now. You take a look at this sheet and you go, bang, your total life insurance needed is $354,000. Now, there's price banding, as you know, at $500,000. So if we want an extra $250,000, we actually get it cheaper than the $350. Let me show you. And then you show them some calculations, and you can validate that it's cheaper to buy $500,000 generally than $375,000, just because of the banding of the pricing. One way to get a higher sale, if they say $375 and you total this up. The other question you have here, though, is replacement income for spouse. So in that area, it says replacement income for spouse. Now, is that a need or is that a want? Put your answer in the chat. And my next question would be, if total life insurance needed, there's a spot at the bottom there. What's your average? Just type in your no one else can see this except me, so we're not sharing this information with anybody. What's the average sale today of life insurance that you're currently making? What's the average sale of life insurance? Just put a number in there. My average sale for life insurance is X hundreds of thousands of dollars, whatever it happens to be. I just want to get an idea of the group again. If we were doing this live, I'd be asking that same question live. Yeah, a couple more answers. I've got a couple of answers, so I appreciate that. Yeah. Yeah, there you go. Interesting, right? Because, well, if you go back to that slide that I showed you, the average here, if I just averaged it, is looking like about $500,000, which if you and I were having a chit chat, and $500,000 to a person making $60,000 a year or $55,000 a year sounds like a lot of money, right? $500,000 check comes in tax-free. It's a lot of green, but it's not enough, because your human life value is a multiple of that number. Now, this is not a conversation that I think you're having with your clients. When you're sitting there saying, replacement income for spouse. So, well, what does that mean? Like, is it $50,000 for 10 years and that's $500,000? Or do I want to provide that income for the rest of her life or his life? And if they're 35, that's $1.5 million, $1.5 million. When it gets over that $1 million, other things start to come into play. First of all, they're thinking, man, that's going to be expensive, right? The next thing they're going to say is, how am I going to pay for it? The next thing they're going to think of, and they won't say it out loud, is if I'm going to buy $1 million of life insurance, I know where the premium's coming from. It's coming from my genes. And if it's coming from my genes, it's not going into my lifestyle or my accumulation pile. It's going from my genes to your genes. So I'm going to go as little as possible. And that collapses us back to that 500,000 or 350 level. Here's the question you want to start asking people. And it's going to sound weird on the webinar here, but I always do this with a couple. I say, listen, I just did it not too long ago with a young couple. And I said to them, when we talk about insurance needs and wants, I mean, I don't obviously say those two words. I talk about insurance needs. I said, let's just say for it, and there's a situation here, you probably have one in your town as well, but a few years ago on the Hamilton Skyway Bridge, a truck went over the bridge, and you'll see this on YouTube all the time, its top had opened up. The dump truck at the back opened up. The guy hits the bridge with the dump truck. It rips apart the bridge. The load's dumped. Cars come up behind and get into this thing and hit it. Here's the question. So do you remember that time on the Burlington Skyway Bridge, that dump truck took out the bridge? Everybody remembers it because you had to bypass the bridge for like a month while they were fixing it. They go, oh, yeah, I remember that. The guy was drunk. What if the guy was drunk and he was at fault, and your spouse, Bob, was going to work over the Skyway Bridge and was killed in that accident? how much would you want to sue the trucking company for her wrongful death? I want you to answer that question, everybody. In the chat, put in how much would you like to sue for if your family member was killed in a wrongful death and there was a payday. It was like, I don't want to say the Coors beer truck. That's the example everybody else brings out, the Coors beer truck, but it was the trucker that went over that bridge, or his transport truck went sideways in bad weather and took $3 million. Geez, all of a sudden we've gone from $500,000 or $1 million to my first answer here is $3 million. Anybody else who'd like to sue, and how much would you like to sue for? Just going to wait a second. I want some more numbers in here. Because even $3 million is low compared to the numbers I usually get. People say like $10 million. I'd say 10. My wife is worth $10 million. An infinite amount. Yeah, absolutely. Life is precious. Life is valuable. It's crazy, right? I'm going to share something with you. I'm going to go to some software. Now you can do this manually, or you can use the insurance carrier's calculator that shows you this number. But I have a calculator that actually shows you a couple of things I think you'll find interesting. Hopefully you'll find them interesting. I'm going to go to that now. I want to show you this. So let's look at their income. We go up here to this little income, and I'm going to say this is a 35-year-old individual. I'm sitting with his spouse between now and age 65. They're earning years. Let's say that they're making $100,000. I'm just going to say $100,000 a year for sake of math. I'm going to say they get 3% raises every year from now until their 65th birthday. We can debate that, or I can not put it in. And I'm going to put 0 on money spent for self-maintenance. Now I'm going to show you the calculator for human life economic value. This is a term that you need to start using. Do you know what your human life value is? And they will always answer, I haven't got a clue. What are you talking about? Human life value. Your human life value, and just remember this number, $100,000, is usually somewhere between, depending on the carrier, 20 and 30 times your income. It also depends on occupation. So when they ask you what your occupation is, they're asking you for a reason, because if you're a doctor or a lawyer, in the minds of underwriters, you're worth more. So the more towards the 30 times calculation than the 20 times calculation. Let's just use this as the example. Your human life value is $4.7 million. So if you were killed in that car accident, your earning potential between now and your 65th birthday with 3% raises at your current income of $100,000 is $4.7 million is going to leave the family bank account. How do you feel about that? And your client's going to go ballistic. They're going to, I never thought about that before. What are you talking about? How does that work? That's exactly how it works. It's about, again, if you look at my example here, this is about 30 times with 3% raise. This is about 30 times income to that 4.7. Now I can do the documentation in my software. I can show you the documentation of a chart. I'm not going to do that today. We haven't got time. I'm also going to show you this. So now if we go lifetime potential, if I had $100,000 and I was 35 and I had 3% growth rate, at your retirement age, the potential would be the $4.7 million. But if your company paid you that income up front and you invested it, it'd be worth $11 million. Now that's a pretty nice thought. But unfortunately, our companies don't pay us in advance of doing the work. You'd be a lifetime contract and you have to live to the end of your life to make it happen. And they don't give it all to you without tax. It would look like this. You took every penny you ever made and you invested it, and it'd be $11 million by the time you're 65. Now, unfortunately, there's taxes. So I'm just going to put you at a 30% tax rate. Let's take a look and see what effect that has on that line. Whoa, $8 million. You're not saving 70%. You're probably saving currently about 5%. So let's put that in there. So that's what it looks like. So now, if you're only saving 5% of your income and you got that $11 million, you'd have $585,000 in your savings account. That's a 5% interest rate, or 5% of your savings, sorry, and you had no debt service and all your money went to lifestyle, but you actually have debt service as well. You're paying interest on credit cards and you're paying mortgage payments. So I'm just going to put 5% in there. Now we're going to apply the changes. Now we're at 0. So what happened? You see, the potential earnings of everybody is quite high. A lot of money is going to come into this pot right here. And we've got to be very careful with the money as we go through this pipe and push some of it into savings and investments. This is your investment tank. All of your investments are going to go in here and become your RSP. That's going to fill up. Some of it's still taxable. And some money's going to a savings account, your TFSA, your bank account. But we got to make sure that we're prepared for when this pipe gets cut at 65, that there's enough money in here to sustain your lifestyle if you're still here to enjoy it. If something happens to you ahead of time and that pipe is cut, your family is going to require a substantial amount of money to maintain their lifestyle. So remember earlier when we were talking about this, that $500,000 isn't going to cut the mustard if actually something happened. So how much between the $500,000 and the amount you're eligible to have, the $4.7 million, would you like to have? If you could have it for no additional out-of-pocket outlay, how much of it would you like to have? What would you say? I want to hear your answers in the chat. So if you could have somewhere between the $500,000 and the 4.7 million with no additional out-of-pocket outlay, no diminishing your lifestyle, how much of it would you like to have? I'm getting an answer here, all of it. And I got to tell you, folks, 95% of the time, that's the answer. I'd say, I'd like as much of it as I could get. Absolutely. You'd be crazy not to want as much as you could get if it didn't diminish your savings component and or your lifestyle today. You want this. Now, I've just changed your mindset. You see all the people in the call here right now? I've changed your mindset from needs-based planning to wants-based planning. Remember the bus, remember the house, remember the public school, remember the Ferrari, the nice house, college. You're now in the mindset of wants. I need you to change your mindset when you're coming to my office to have the conversation about your joint first to die mortgage insurance. I have about 10 minutes to have an impact on you to get you to be in that wants philosophy. I don't have a lot of time. And the customer is thinking, there's another exercise we used to run all the time in the insurance business, mind of the agent, mind of the prospect. The prospect is thinking, things that we're thinking. We put ideas in their head that they're thinking that they're not thinking. I'll bet not many of us on the call are sitting with $4.7 million of life insurance because we haven't worked with somebody who can find out where there might be losing money unknowingly and unnecessarily to have that life insurance. So again, when we go through this list of items here, your balance mortgage owing. You have a mortgage? They say yes. How are you paying for it? Are you paying for it monthly, annually? Have you got a 15-year mortgage or a 20-year mortgage? There's reasons why you might want to have a 20-year mortgage versus a 15 mortgage because there's no difference. I can show you mathematically there's no benefit to having a shorter mortgage, a 15-year mortgage versus a 30-year mortgage, because I just freed up monthly payments that I can use to acquire wealth and be a wealth creator as opposed to a debtor and or a saver, right? I want to be a wealth creator. I like being a saver, but if I can move towards wealth creation, that's where I want to be. You want to be in a position to get all of your clients to be wealth creators. You want to talk about referrals. When you go through this exercise and we go through the fact finder when we do it live, and we show you the strategic ways to do that to get your client in a wealth creation mindset. They are going to tell everybody they know about the job that you did for them to help them get where they're going. You won't have to worry about going out and finding all kinds of new leads and finding new people to do business with. You're starting to become referable because everybody wants that. Everybody wants to know they're going to be okay, and you help them get there. The emergency fund. If I had an emergency fund, if I had nobody, I don't care who you are on the line even, nobody's sitting there with $20,000 in an account someplace. They used to say, have 3 months savings saved up. And then it went to 6 months. I think Dave Ramsey says 6 months of your income saved up in an account for an emergency. Now, I don't know about any bigger emergency than the one we've just had for the last 2 years, but if anybody had an emergency account, it's flushed out. It's done. It's gone, been used. But it's access to capital that I need. I need access to cash if I need it. I don't need to have the cash, but I do need access to cash. It's called liquidity, use, and control. If I can put you in a position of having liquidity, use, and control of your money, you're going to be much happier than someone stressed out about, what if I lost my job? What if COVID-19 comes along? What if the war gets bigger in Europe? We're thinking about different things. Bad things are happening. That's why $500,000 isn't enough. And we've got to show people how to put more in place on their lives. Now, I've got a series of 10 questions that I want to just quickly go through with you. These are 10 questions in preparation for a total needs analysis, a total fact finder. One of the questions when you're sitting down with this person and going over the fact finder and needs analysis you're getting from Western Financial Group is that, what are you currently doing in preparation for your financial future? What kinds of things have you acquired so far? So on your sheet, it would be in that liquid assets, including cash, stocks, bonds. What kinds of things have they done? What kinds of financial instruments have they purchased up until now, up until today when they're sitting in front of you? What have you done? You need to know what they've done to know what their propensity is to do other things like it or to do things they aren't currently doing. But you need to find out what they've done and why they did it. So what do you like about what you're currently doing? They're going to tell you, I love paying down my mortgage. I love my RSP. Great. Just mark that down. What don't you like about your current financial position? I'm not very liquid. I don't like where my RSP is invested right now because the market's tanking. It's going down like 10% a day and up 10% a day. It's too volatile for me. I'm uncomfortable. What would you like to see enhanced or improved? Better return, more diversification. They're going to tell you something. You need the answers to these 10 questions. This is a really, really important question, which we will explore more when we see each other next time. Describe the ideal financial professional strategy or product. If you and I could design the perfect financial instrument today, what would it look like? And then we'll go through that exercise, and it's kind of interesting what happens as a result. What's been your past experience in preparing for your financial future? What you're really asking there is, who else are you dealing with? Have you got an insurance advisor? They're in front of you today because they're doing something at Western Financial Group, but they might have an insurance advisor somewhere else. It might be London Life, Prime America, whoever, right? Doesn't matter. What would you ideally like to accomplish with your financial strategy? Like at the end of the day, what do you want this to look like? What's the goal? When do you want to retire? Tell me a little bit about that. What's it look like? Tell me about your decision-making process. When you made your last major financial decision, what process did you go through to make that decision? If it was acquiring a house or acquiring a car. Some people go online and they look at the, all the consumer reports on cars before they buy them. Some people just go in the dealership, like the color, and buy the car. It takes about that long. But some people research the hell out of everything, ask their friends, go on consumers reports, go on the internet, search all kinds of things. How do you like me to present my findings? Are you more graphical or numerical? Like, did you folks enjoy the pictures today, or would you rather see real numbers? And I can adjust my style to fit the style of the person I'm talking to. So if they're more numerical, I go to my charts and graphs. I show you that spreadsheet, that document. Every time today I avoided documentation, and you said to me, no, I like numbers. I would have shown you the documentation and you would have been thoroughly impressed. For most people, just give me the bird's eye view of it. And the last one's really important. When you think about your money tonight, you think about your life. What keeps you up at night? Is there anything on your mind right now that's keeping you up at night? There's 10 questions there that will really give you some guidance as to what they're looking for and the direction that they're in. Once we know where they're going, right, and what they're looking for, all we've got to do is help them get to where they want to go. And we do that through a series of questions. And those are the 10 questions that position the questioning piece of this. In our next webinar, we're going to talk about the actual delving into those kinds of questions. I've got a presentation called Are We Asking Enough Questions? And we want to make sure that we're asking enough questions to get the information we need so we can go back to our office and put a plan together for them to get them where they want to go. So here's a question. On a scale of 1 to 10, how did today meet with your expectations of today? So I need everybody to give me okay, well, I can't work with a 20. I can't get better, so we're done. Yeah, on a scale of 1 to 10, how did we do? You need to ask your clients this question. You say, Debbie and Frank, on a scale of 1 to 10, how did today meet with your expectations? And they're going to tell you, well, it's about a 7 or an 8. I prefer a 7 or an 8 because then I have a follow-up question. How do I take you from an 8 to a 10 in the next 5 minutes? So I've got some work to do in the next 5 minutes to take you from that 7 to that 8 to that 10 because I didn't meet all your expectations. And my goal through my questioning is to meet all of your expectations. Doesn't matter what I think or who I am or what I care about. It matters about what you care about, who you are, and what you think. So that's why you ask that question. Okay, folks? Thanks, everybody, for your attention. Have a great day. Stay safe.